Welcome to This Explainer. Today, we're going to break down a truly fascinating scientific study on stock trading. We'll be looking at the absolute top 100 stock performers of the last 12 months to decode exactly how they moved. If you've ever felt completely overwhelmed by the sheer volume of data, opinions, and noise in the markets, well, you are in the right place. Today, we're exploring the incredible power of radical simplicity through something called the Volatility Contraction Pattern, or VCP. Let's get right into it. I want you to honestly think about this for a second. What if you only traded one setup? Just one. For most struggling traders, information overload is incredibly frustrating. Think about it. There are just way too many successful traders to try and copy. Way too many different styles, a dizzying array of indicators, and countless chart patterns. When you combine all that noise with the very real emotional stress of putting your own hard-earned money on the line, it's a recipe for disaster. The entire process just becomes totally overwhelming. To shatter some of that conventional trading wisdom, just listen to this phenomenal quote from legendary trader Kalamagi. He says, "Aim for 10 to 50x risk multiples. If you need a 60% win rate, your setups suck." Wow. This completely shifts the focus, right? It's not about being right all the time. It is entirely about asymmetric risk. The goal is letting a few massive home run winners pay for your small, strictly controlled losses. So here is the roadmap for today's scientific case study. We'll move from market chaos to absolute rules-based clarity. We're going to cover 1, overcoming information overload, 2, scanning for VCP setups, 3, strict entry and exit rules, 4, the shocking study results, and finally, 5, some real-world case studies. Okay, let's dive into this. Section 1, overcoming information overload. By focusing entirely on the volatility contraction pattern, you completely remove the dangerous urge to force rushed trades. The core philosophy here is to step back and go slow. VCPs inherently take their own sweet time to develop. You get to just sit back, take your time following these stocks, and observe the price movements before ever feeling the pressure to press the buy button. Remember, taking the time to observe is a massive advantage over failing quickly and getting washed out as a beginner. Section 2, scanning for VCP setups. Let's treat these rules like a VIP bouncer for your portfolio. These are your basic ground rules, specifically designed to weed out illiquid microcaps and create a highly curated watch list. First, we're looking for stocks that are up the most from their 52-week lows. Then, we filter for a market cap over $100 million, a share price strictly above $1, and a daily dollar volume above $10 million. This ensures you're only spending your valuable time looking at stocks with serious institutional support behind them. And this brilliantly illustrates how broader market conditions dictate your action. If you run that scan in a raging bull market, you're going to get hundreds of names. The absolute best time is early in a bull run, when stocks are emerging strongly from a bear market. Those are the ones that deliver multi-bagger gains. Conversely, in a bear market, this list shrinks dramatically, and even the best setups frequently fail. It reminds us that sometimes doing absolutely nothing is the smartest move you can make. So what exactly does the structural anatomy of a clean VCP look like? Well, we want to see at least 3 contractions, featuring progressively narrower ranges, ending with clear tightness on the right side of the base. Crucially, that last contraction depth must be lower than twice the stock's average daily range, or ADR. So if a stock usually moves 5% a day, that final dip shouldn't be deeper than 10%. This step is vital because it ensures your stop losses remain completely logical and manageable. Section 3, strict entry and exit rules. Let's talk execution. Having a strict, rules-based approach entirely removes emotional subjectivity. You either have a setup or you don't. Your entry must happen no more than 5% from the breakout level. Your stop loss is strictly capped at under 10%. And if the breakout happens with a gap up, you buy the break of the opening range highs. If a trade doesn't fit this exceptionally tight risk profile, you simply skip it. No exceptions. Now, what's really interesting about this is how we tailor the exit strategy based on a stock's natural volatility to avoid premature stop-outs. We use exponential moving averages, or EMAs, as our trailing stops. For fast-moving stocks with a ADR of 10% or higher, we hug them close with a tight 10-day EMA. But for slower movers with an ADR below 10%, we give them room to breathe using the 20-day EMA, preventing you from getting shaken out by just normal everyday price action. Section 4, the shocking study results. Let's see what the data actually says. So, how did this single setup system perform over the last year?
Out of the top 100 performers, there were exactly 36 clean, tradable VCPs. And look at the breakdown. 33% occurred during the raging bull markets of August and September 2025. Notice that the correction months accounted for a mere 11% of setups. This naturally protects patient swing traders. A lack of setups simply means a lack of trades, effectively shielding your capital when the market is dangerous.
But here is the most important math behind those 36 trades. The average risk across all of them was just 6%, while the average return was a massive 69%. That yields a staggering 11x average risk to reward ratio. You are literally risking 1 to make 11. Now, we do need a quick reality check regarding survivorship bias. We are, of course, looking at the top performing stocks in hindsight. But here's the truth. Top traders make their real money on just 10 to 20% of their trades. The rest are usually break-even or small, strictly controlled losses. A very small number of outsized winners drive the vast majority of profits. That's the secret. Section 5. Real-world case studies. Let's look at the actual proof. Unsurprisingly, most of the biggest winners came from hot themes like AI, data centers, and semiconductors. Take SNDK from August 2025. It was already up 70% from its April low. It formed a completely perfect VCP with 3 precise contractions, 19% deep, then 12%, and finally a super tight 7% contraction. The breakout triggered at 46.50, meaning the stop loss represented a very manageable 7% risk. Let's move on and see how this builds, because the result is just wild. Since SNDK was a fast mover, the rule was to trail it with the 10-day EMA. The stock took off, respected that line all the way up, and finally closed below it for an exit. That was a 325% move on a 7% risk. That equates to a staggering 46x risk-to-reward ratio. Next is MRVL, which proves how powerful gap-up entries can be. After 3 contractions, it broke out on huge volume. By entering at the opening range high, the risk was kept incredibly tight at just 3%. Following the same trailing rules resulted in a 170% return. Because the initial risk was so incredibly tiny, the return multiple supercharged to a 56x risk-to-reward ratio. Absolutely incredible. And briefly, let's look at Dell. This was another prime example of extreme outperformance using this exact same blueprint. Up 130% from its lows, it formed that classic 3 contraction pattern. Risking 7% on the breakout led to a 170% return, netting a fantastic 21x risk-to-reward ratio. The big takeaway here is that you absolutely must study past winners consistently. Note the market conditions, the themes, and the fundamentals when these setups form. Doing this trains your eye to distinguish true A-plus home run opportunities from the choppy, mediocre ones. I want to leave you with a provocative question to really think about. Take a hard look at your own trading. Are your current setups actually giving you the 10x risk multiples you deserve? Or is it finally time to cut the noise, step back, and radically simplify your approach?